Hello and welcome to another episode of the Stock Market Today video. This is our weekly wrap up that we do on Fridays. I'm Justin Nielsen filling in for Ali Corum. And of course, joining me as usual on Fridays is Mike Webster, our senior market strategist, and coming to us from a hotel room. Sorry,
Clearly.
folks, for those of you that are joining us live and have been waiting. We had a lot of technical issues that we were dealing with. This is my third microphone headset series. We had ports, we had everything going. And hey, you know what? That's just really kind of in line with what kind of week we had, right? Everything was kind of looking very bullish. Wednesday Fed reaction, some wild action there, and then a strong bounce today. So we're going to cover all of this. It's December 20th, 2024. We're almost at the end of the year, and boy, is there a lot to talk about. So, Mike, I'm going to throw up a little chart because I
I'm going
know
to
how you
throw
love
up
your
too
charts.
after our pre-show.
Right. So
I think we should
here is the
record our
NASDAQ
pre-show.
composite.
I think we should
Oh
record our
man, you
pre-show
know what?
and put it
That's
out as bloopers.
right. Well, and hey, you know what? I'm impressed with us that we kept. I think we kept the cursing out. So yeah, so that was good.
You did.
But yeah, Mike, let's talk about this because we had we had really such a strong move here, really from September 11th, and we've had a lot of tests of the 21-day moving average line, but then we were really kind of rocking and rolling, and things were just looking really good. Um, I don't feel like the Fed, there was necessarily like, oh, everyone was expecting the rate cut. Everyone was talking about it being a hawkish cut, but certainly you never know with the Fed. The Fed might do exactly what is expected, but the reaction to certain words, certain parsing, the algos going crazy, whatever reason you want to blame it on. Here we were above 20,000 on the Nasdaq Composite, and boy, did we lose that in spades as we plunged back below the 21-day moving average line in a single day. So now with today's bounce, is it game on again?
Possibly, yeah. So this was a very important week and a very important close that we had. We'll circle back to the Fed thing in a bit, but let's just kind of go through what happened. All was looking really good. Let's pull up SPY, and I think this kind of illustrates what happened on the Fed day. It was kind of forming this tight little shelf. There and looked like it wanted to break out on Wednesday. And in fact, it was. And when we were looking at the regression lines on IBD Live in the morning, it was perfectly set up to where the trade was to go heavy, SPY. And then once the Fed news came out late in the day, we just fell apart. Let's go to an intraday chart to kind of show what happened there.
Okay, I'm going to go to SPY on a 10-minute chart.
Okay, that works for me. All right, so you can see how tight on Wednesday was trading, if you could point to that. And then it just, once the news hit, and then of course once he was talking, we just fell apart. And the only thing that kept us from going lower was the fact that the bell rang. Because we were those that. For people who don't understand kind of the market mechanics of what happens on a Fed day. So it happens late in the day, which I think is a big mistake. They should do it, maybe an hour into the open if they're going to do it during trading hours. Happens late in the day. They put the press release out. You've got all the algos that read the text and they look for changes and keywords, and you have instantaneous trades that the computers are doing it faster than anyone could read or process anything. And it's like, oh, if this word gets dropped, we're going to buy. If this word gets added, we're going to sell, and so on. And, this is just speculation, my speculation, but most people, I think, believe this, that they're driving that because most traders are sitting there waiting to see what Powell has to say and then kind of interpret it and, listen to it afterwards. I've listened to that speech probably 5-6 times since then, just looking for key things. And you can't do that in real time, but the computers can. And so the selling started. And then once we took out the lows from the day before, then that brings in more algo type of selling that are based on lows of days or highs of days. So it snowballs. So we always say the real reaction to a Fed um, a day, because that happens so late in the day, you get the press release, half an hour later, press conference starts, and then it ends just shortly before the end of the day. So real traders can't do much trading during that based on what he said. So then you have the Thursday and Friday. Now, this was an option expiration Friday that made it even trickier. Plus, we're at the end of the year where a lot of people are on vacation. So it was a perfect storm for volatility, and that's what we got. But you want to see how did it react to key levels. So today we gapped down, which is what we want. Let's go back to the daily, and let's go to the Qs. In fact, that this was a normal kind of textbook shakeout within an uptrend, in a powerful uptrend, where you get 3 days down with your third day being your support day. Let's go to the Qs if you don't mind.
Oh, this is the Qs.
Oh, I'm still seeing SPY.
Oh, okay.
Okay, now I see Qs.
Okay, well, that's good.
So you break, I know Tuesday we're down, but it wasn't a material amount.
Right.
So Wednesday you get your real break. Yesterday was weak again, and then today what was important is we started off weak and closed strong. That kind of cements today's low as a key level, kind of an equator line, as I like to call them, that if you're above it, good things should happen. If you're below it, bad things should happen. So today's low is a nice line in the sand. So I think you needed to reduce exposure on Wednesday because we didn't know how bad things were going to get. We have a few examples to look at in a little bit of similar type of setups. And some of them get really bad and they go under, you and I looked through all of the similar setups along with Chris Kessel yesterday. And we look at all of them from the 70s to now with a similar type of break that we had on Wednesday. And most of them, need a lot of time before they work themselves higher. There were a few that were just short-lived. You came in for a few days and then you rallied back up. Hopefully that's what we have right now. And we'll kind of know that with today's low. If it gets tested right away next week and we close below it, then we're probably looking at an intermediate correction. And that could be, 8% or so, give or take, and could last, a number of weeks, probably into next year. But if today's low can hold, we'll probably rally into the end of the year. That's kind of the base case on both ends, just with the market mechanics of an end of the year and with having this shakeout. And it was really nice to see with the shakeout, it kind of separates out the stocks that are just being brought up because of the market and all the froth that was happening to the real leaders. So it's something you welcome. It's never fun. I mean, it was painful. Wednesday was very painful and, a lot of activity that had to be done if you're an active trader. But you can run your screens this weekend. You can look at the RS line. You can look at how things came back today to kind of separate out the leaders, the laggards, and the ones that are just being moved up and down with everything else. So I think this was a very good week for active traders because it gave us a lot of information.
Mm-hmm. And it's also worth mentioning, as much as there was the reaction to, the Fed, one of the key pieces of news today, of course, was the PCE, which is one of the Fed's, most watched inflation gauges. So look, if that PCE had come in different, would we have had a different reaction to the market? We don't know, right? We can't go in the past and change it. But it's important that there was a reaction on Wednesday and that you were ready for kind of it to go either way, right? You had to be ready for, yes, maybe this is the third day down and we get a bounce, or it honestly could have gone, the other way where we went below the 50-day moving average line, things got worse, and we had to do even more defensive action. So this is where sometimes not doing anything can be okay, but it's not necessarily, even when it works, it's not necessarily the best thing to do.
Yeah, in general, unless your trading style is to wait until the end of the month or wait until the end of the week, which there's nothing wrong with that. That is a valid style. In fact, every style is valid. It's just you don't want to mix your styles. You don't want to, say,
Hmm.
okay, the market's getting hit, so now I'm going to wait till the end of the week. If
Right.
if that's a recipe for disaster, right? Um,
Now
but
I'm a
if that's your
long-term trader.
yeah, there's nothing wrong with trading off of weekly charts. Bill did a lot of that. He was very active. Bill O'Neill, the founder of IBD, that we both worked so closely with, you know, he would base a lot of things off the weekly, but he would be trading all week long, and he would be looking at intraday charts, and he'd call me up and say, Mike, pull up the 5 minute on Corning or
Hmm.
whatever the stock was that he was trading. And because he was a tape reader, and even though he was using the weekly chart for the bases and for major things, the active trading that he was doing and the massaging of his positions was done using daily and heavily intraday. Um, so you look at everything, and and you have your strategy, but let's look at the weekly on the cues here, just to kind of give you a sense of where we close within the closing range. And I must have a lag because I'm not seeing the weekly. Okay. And
Okay.
what is the closing range for this week?
Um, so let me go there. Looks like it's 64%.
Okay. And I didn't see it on there, but do you want to explain to people what a closing range is?
Yeah, so basically the closing range as we calculate it is if you take a look at where the high was and where the low is, that gives you kind of your range. And then it's simply where do you close in it? If you're closing at the top, that's 100%. If you're closing at the bottom, it's 0. If you close right in the middle, that's 50. So 64% means you are closing in the upper part of that range. Um, and I mean, it sometimes doesn't. Oh, I'm sorry. I was looking at 64% as the volume. My apologies. It was 31%. I was like, that really
Oh,
doesn't
okay.
look like it's in the upper
Yeah,
half.
that's why I was just like,
31% is, yeah, 31% is where we were at. I was looking at the wrong number there. My apologies. So,
no
31%
worries.
in the lower part of the range, and 40% was one of the areas where Bill would look at as being a support. Now, of course, the fact that we got that real bad move on Wednesday and we were at our lows on Wednesday doesn't give you much time to recover on a Friday, but it is what it is, right?
Yeah, so getting up that high, up to that key 40% level, which, Bill and I did a ton of research on that. That's something that he came up with long before I started working with him, but then we kind of took it to the next level. It's a very important concept for both stocks and indexes, and it's when you're coming down um, in the market, so a down week, and if you're closing a 40% closing range or higher the better. It's thought of as actually a good week, an accumulation week or a support week. And so this one, like you said, I mean, we made a lot of progress off the Wednesday low. That was pretty impressive, but we couldn't quite get up to that 40 level. That's why we want a little bit more information. Let's go back to the daily. And one of the things that you and I came up with, along with Charles Harris, when we were doing the market school rules back in the 2011 timeframe, was the importance of trying to reduce the whipsaws around moving averages and using the low getting above it. Could we go to the daily?
Yeah, it's on the daily.
Okay,
It's just your
I'm
lag.
still seeing the weekly. There's some sort of
Hmm.
lag here. Um, I've got my horse and buggy up front, so I guess we're going
Ah.
back to those days. Um, so with this one, we closed back at the 21 day, which is a key level. It's good that our low held above the 50-day, but we didn't get our low above it. Obviously with such a weak open, that was impossible to happen today. So next week, that's what we're going to be looking for. Can we get our low above the 21 day? And that's, of course, what I use for the Webby RSI. So right now, the Webby RSI is non-existent because our low is below the 21 day. You need your low above it to have any type of measurement. Let's also look at SPY. SPY
It's
looks a
also
lot
worth
worse.
mentioning that our high didn't get below the 21-day moving average line. So
Very
that was kind of
important.
nice.
Yeah.
But yeah,
Yeah.
I'm going over to SPY. So that's
I will see it in 15 minutes.
right.
There we go.
So
Um, Yeah, so the high didn't get below the 50-day here either, which was, a good thing. But let's just bring in the reality of how bad things have been and pull up the RSP. because RSP is the equal weight of SPY, and this is what your typical stock was doing over the last month. And, not pretty. Still waiting, but I know what it looks like in my head. And it has been going down, down, and down, and down, and not something you want to see. So
And
your
the
average,
highs were well below the 50-day moving average line here on RSP. Really starting on Tuesday is when the high, was below the 50-day on the RSP, and this really looked like it was coming down to the 200-day moving average line.
yeah. Yeah. So this is, if you're those people who are very negative right now, you have you have a logical reason to be negative because this RSP looks terrible. Let's pull up IWM. That looks bad as well. And there are a lot of things out there that look bad, but our that cracked through the 50-day, even though we were up today, there's a mediocre bounce. So you wanted to stay away from the smalls, the mid caps, and your average stocks. It's really about, let's go to the FNG S, I guess, for the
Yeah,
single. And I do have
FNGS
a
is the non-leveraged version of the FANG Plus index, the
and
NYSE
I do
FANG
have a
Plus index.
position in Qs and the thing.
Yeah, I have leveraged positions in Qs, and I do have a leveraged position in FNGS as well.
So you can see how nicely this held up. So this is only 10 stocks that each a 10% weighting, things like Apple and Broadcom, and which I have a position in, Nvidia and things like that, Google, which I have a position in. In this, you look at this and go, it was a nothing week. Like, you came down to your 21-day, you didn't even close below it. Doesn't even look like it traded below it. So it's a kind of a tale of a couple different markets. You've got your mega caps that are looking very normal. In fact, let's pull up Apple. Apple looks really good. And then your average stock, which was your RSP that we looked at. So look, I mean, Apple is right now is at a different part in its life cycle. It's just kind of a cash cow type of stock. So it's not the growth stock that we would be trading from a kind of an orthodox standpoint. But that was an outside day, upside reversal today. Looks really good. Looks like it wants to go higher. And when you've got stocks like this, and let's also pull up Google, and you can almost pull up just most of the mega caps, and they all look healthy. So that was enough on that, I guess. We could, and this is the type of reaction that you want to have. It broke out, came in a logical and normal way that the breakouts come in and test. Low stayed well above the 21-day. You had an upside reversal. This is a day you could have entered it, frankly, if you didn't have it before. I had sold mine and I bought mine back. I'll just use today's low as an exit point. So there are a lot of the big ones that look like this. So that counterbalances the IWM, the MDY, the RSPs looking terrible, and SPY still looking like it's in trouble to a certain extent.
I know we usually leave the regression line analysis and everything for the end, but this week was so important in terms of the regression. I'm going to go ahead and front load it, and we will get to more stocks in just a few moments. But I thought it was maybe important that we kind of take a look at some of these typical charts that Mike goes over on the end. And again, he's in a hotel room right now, and so we're doing this off of screenshots. But this was pretty gosh darn close to the close. Actually, it was right at the close. So let's go through these charts real quickly. So you've got the Nasdaq Composite Weekly that I'm showing right here. This is just showing the candles. Again, a pretty large body and a very large wick at the bottom on this week.
Yeah, the bottom wick is important. That's a just a picture that same thing by closing at the lows for the week. It would give you a completely different feel, and that's the advantage of looking at a weekly candle. And so that becomes that line in the sand. I know it's kind of hard to see the bottom wick on there, but yeah, there you go. And there it is on SPY. SPY does not look as good. So it's just always good to take a step back and see, does it look abnormal? And this does not look abnormal. It's just, we're not in a runaway, just every week going up type of mode. We're in this kind of corrective type of phase, which is normal, you know?
Mhm.
So yeah, we can move on to the regressions now,
So, and here's SPY, just real quickly.
you know, on
Again,
the weaker
as
side.
as you said, a little bit weaker, but nothing that is like completely broken here. Here's the regression on SPY, and this kind of fell out of that regression channel line. Just as a reminder for folks, we always take a look at these regression channels. The white dashed line is the regression channel that's basically a best fit of the area. We're starting at August 5th and going 50 days out, which is to October 14th. So if you were going to do this on your own, that's where you could set your regression channel line. We have one standard deviation above and below. That's the solid line, the red solid line above and the green solid line below. And then we have a half standard deviation above the red dashed line and a 0.75 standard deviation below. This is the green dashed line. So we were kind of looking at this, you know, I mean, earlier this week, we were looking at a bounce at the solid regression channel line, a reason to be thinking that a mean reversion was going to happen. And again, that's you have to have some type of expectation, but you have to shift gears when the market does something different. You can't just say, "Oh, well, this is what it should do," and if the market doesn't do it, you got to adjust, right?
The last time I checked, the market doesn't care what I think. You know,
Right. It's proven
um,
that over and over, right?
yeah. So look, this one, when it was down there at the bottom of that, I was pressing heavy on SPY. I was actually using the triple, the U Pro there because you knew that you were wrong if it took out that low. It's kind of hard to see on the chart, but the low from the day before that bad candle, because the expectation was for it to rip up to the white dash line, the mean reversion trade. It like we had back in, a few times during this, and that happened. That's a very standard thing when you're looking at regressions. But then when it broke down through those lows, your expectations were broken, and you had to back out of that trade, and that got very ugly very quickly. So now at this point, because we're so far below that line, even though it's only been a couple days below it, I'm kind of throwing out that earlier trend on SPY because it's broken. Like it can bounce back up and do something different, but for now, you've got to know using precedents as well as using regression lines. You got to know when to throw them out, and so you've got to throw this out and just say, okay, I'm not using it there. But now let's look at Nasdaq or the Qs, whichever one you
And,
have
and just
handy.
real quick, I want to point out because we did, go below that regression channel line before, and
Mhm.
you didn't throw it out then, but it's kind of the way in which it does it,
It was how
right?
far below it got, right?
Yeah,
So at that point, it was just down there, and I was right on the brink of throwing it out.
yeah.
But that was right before the election, and we were given a little bit more time because we knew we had this big. You use rules, but you also use your mind, right? You're like,
Mhm.
when things happen, and you're like, okay, but there's an election the next day, you give it a little bit more room. We don't have an election next week. We've got a whole, it's Christmas week and all, and so we've got a half day, we've got a day off in the middle of the week. You're going to have light trading, lots of volatility, most likely. And so we've come so far below it without a risk event that everyone is waiting for. So you've got to throw this one out at this point.
And now here are the cues. Um, Intact. I mean, you had a test
Yeah.
back here of that regression channel line. Um, right now, this just looks like another successful test, and we're right at that dashed green line, so very close to that 75, 0.75 standard deviation.
Yeah, we were trading, through it. We came off a little bit near the close. You don't want to read too much into the last hour of a quad witching day because you've got all the market mechanics around the options that are going on, whether it's good or bad. You just don't want to read. Um, Sorry, my alarm's going off. You just don't want to read too much into it at that point. But you look at the low and where generally where you close, and we were right up next to that 0.75, and that's why I was kind of switching gears from coming in light today to once we gap down, which was my expectation for the third day of a pullback that ends up moving higher, is once we started firming up, we started adding things on Swing Trader, and I started, adding stocks into my account or back into my account, besides the core ones that I had been holding through this, because the expectation was it wants to mean revert back up to that white line. Now, if that doesn't happen next week, then that's giving you feedback that we might need to chop around a little bit longer. And frankly, the examples that you and I looked at with Chris yesterday of similar setups, most of them needed more time. So if we just go based off our first take out our research, that we'll probably have to share next week, because we're kind of going, probably don't have time today, but we just need more time in most cases. But there are a few
I would
where
say
we
maybe
just
there's
come.
there were maybe like 10, 15% where you came like right back.
Yeah,
And then, there were probably maybe 20% where you really went significantly lower.
yeah,
And
below the
then there were a
200 day.
lot. Yeah. And then maybe a little bit higher than that. And then maybe, half where you kind of went sideways for a little while and then recovered. And
Yeah,
then
so for
there was
next
kind
week
of
we'll
maybe a
try to put that data
miscellaneous.
together. Yeah.
And you know what? Maybe this is something we tweet out as well. So
Oh yeah,
yeah,
we can work on that.
as a
Okay,
preview.
so let's go to the composite if you have it,
Hmm.
because sometimes the Qs and the composite are very similar but slightly different. This one looks stronger, but you can't really trade the composite. You can trade it through the Qs as a proxy. This one, picture perfect recovery back through your 21 or your 0.75 standard deviation, the dashed line there. In this one, it looks like it wants to go up to the white line and beyond. And that's why right now I'm bullish, based off of what happened here and using this regression analysis. But a close below today's low would turn me very bearish, especially looking at all those examples that we were looking at yesterday.
Yeah. And I also do want to just, I'm looking at the YouTube comments, and some folks were, commenting on the closing range again. Again, I initially said 64%. I was looking at the wrong number. I was looking at volume percent change. It was 31%. So Action Clips was asking about that. So it was 31% was that closing range. So I just want to make sure everyone had that correct, since I messed that up earlier. And then let's take a look at some of the levels.
Yeah, well, this one is actually your 50% retracement on SPY based on our high and low that I've been using before. And just to kind of let you know, we traded back above it with that red line, and now we're back, came and finally tested our 50% retracement of the move from early November. And so that's just something I'm looking at, that I wanted us to stay above that 583.77 level in general. It's not a huge deal, but it's a sign of strength. Now let's look at the other ones. Okay, so here are the level ones. So this is the same levels that we had on our chart last week. I haven't, didn't change any of them. So that 19,366 was a level that we breached this week, but then we were able to close back above it. So that's another area besides today's low that we want to stay above on a closing basis.
And this 19,366 is right here at the top of this area, previous right before that was right before the election. Right?
That was those highs there. You can see it, since
Yeah.
I'm not on my chart. It looks like in
Oh,
early
you know what?
November.
I thought that my arrow would show up. My arrow's not showing up. So
Oh, okay.
yeah, but yeah, that's where it is. It's at the top of that previous. No, I think that was right. As the post-election bump happened, we had those highs, and then one more test of the 21-day moving average line. But yeah, my arrow isn't showing up. So, but yeah, that's where that 19,366.
Yeah, it looks like
from.
around like November 11th or 12th or so.
Right after the election. Then we've got the 18,730. So
yep.
we still
Yeah,
have
so
room
we're,
above that.
if we break below, if we get down to the 18,730, then we're kind of in big trouble, because then we would have already broken through your 50-day, which is that red line there. So you don't want to get, If we break through today's low and close below it, that's a bad sign. And then
Mhm.
because then we're a magnet to those other levels. Then these levels become important of how did they trade around it. Like so, this 1936 that we had marked on there for a couple weeks. That this was a successful test of it. It broke below it, but it was able to close back above it. And that's what you want to see. They often will test the key levels that we're looking at because everyone's looking at these. It's not, rocket science. You look at, resistance areas, support areas. And so that's why they're important because everyone can see them and they should, if it's healthy, it tests them, it will go below them and then snap back up and close above it because all the buyers are in there and they're waiting for that. There are people, who like to buy where we're selling, where we get
Right.
stopped out. That's a whole style in itself. And if you're wired that way, you can actually make a lot of money. I'm just not wired that way.
And again, it's worth noting that, the lows of today do kind of put a line in the sand for us to know whether we're wrong or not. If we get below the lows of today, that's why it's a little bit easier sometimes to go aggressive when you know exactly where you're wrong. And in a lot of cases, we were looking at some pretty small risk percentages. Now, with some of the heat, of course, those risk percentages were higher because they move a lot more. But for the most part, you were able to kind of say, okay, look, I'm not risking that much, and I have all this upside potential.
Yep. And that's the goal in trading is having those setups where your downside is very little and your upside could be, enormous.
Asymmetric. So here
Yep.
are some levels for SPY.
Yep. And you can see we dipped below, well, we crashed through the 599.64 and never looked back. So that's a negative. Another reason why, while SPY is something that you can trade, you just wouldn't want to go as heavy with it. And certainly, it tested the 583.86 and was able to close back above it. And, we put a trade on this in with Swing Trader, but with a smaller size. And frankly, if it can't hold the 50-day, next week we'll probably back away from it. Certainly, if it takes out today's low, we'll be out of it.
And then let's, as you mentioned earlier, we're going to kind of skip the Webby RSI because it's just not as relevant right now with our lows not being above the 21-day moving average line. But we're still going to look at this, what you call the Bob Marley. And, we've got the green, yellow, red areas, the green kind of being where you want to stay in terms of how far off your highs are in ATR terms. That's average true range. We talked about the closing range a little bit earlier, but the average true range, the true range is taking not just the high of that day, but let's say you gap down. Well, you want to really kind of look at where you came from the previous day. So you'd use the previous day's close as your high. Same thing if you gap up. Instead of using the low of that day, you would want to use the previous day's close. So that's where the true range calculation comes from. You average that out over a given time period, and that's how you get the average true range. I should also mention, because I am seeing it in the comments in YouTube where a few people are saying, hey, I don't see that closing range. I don't believe it's on the indexes. That's why I used
Yeah.
QQQ. SPY, it's going to be on your stocks and ETFs, but it's not on the indexes. So that might be the issue that you're running into there. But go ahead and Mike, talk a little bit about where you're seeing. This is the NASDAQ Composite in terms of its ATRs came down, almost to 4 ATRs off its high, but then stopped.
Yeah, so I have the green shaded area as 4 ATRs. There's nothing magical about 4 ATRs. I use it as a reminder to myself that that's the green area, that the area you want to be lean bullish on. But really, I'm looking at prior levels where it came down because every trend has its own character, and every index and stock has its own character. And so, if you can kind of use this to see like where does it normally pull back to, this one normally pulls back to 3.5 ATRs. This time it got a little bit more than that. So that is and this is using the low of the day, not the close of the day. So you can see at our lows, it came down almost to 4, and certainly more than it's come down, since September, September October timeframe. So it was a warning that this was serious, but it was still good enough that it was able to stay green. And let's look at the
Hmm.
other ones. Not
Spy
so
here.
much with Spy. Yeah, like so Spy had a change of character, and we saw that with the other charts. And so you use the different uh, ways of looking at it to just confirm what you're seeing. Like sometimes something's on the fence, so that's why I'll use the Webby RSI or the Bob Marley or what have you. And so this is all confirming that Spy has gotten a lot weaker, and it doesn't mean we can't rip up from here, but you just want to be a little bit more cautionary, and that's also why it's in the yellow area.
Hmm.
I think there was one
And then I
more.
think, oh,
Did I put
that's all
RSP
I
in
had.
there? Oh,
You know what?
I thought
I
I
don't
gave.
think I had it.
Okay,
Um,
that
yeah.
that's
Well,
fine.
you know what? Yeah, let's shift gears. I'm gonna go back
I do
to
have I do have a couple dates that we can look at while we're on this market thing before we switch to the stocks. Can we go to the
okay.
Nasdaq and go to and this is from the work that you and I were doing and with Chris. Let's go to November 15th of 1991. And what we were doing is trying to find times where it looks similar to this setup. So we were looking at where we were near highs, we had a break in a similar fashion. We won't, bore you with all the details, but we were looking for times that it looks similar. And this was similar to the break that we had on Wednesday. And
Very similar, even down to the small day down, followed by a big drop. So yeah, right through the
exactly.
21-day moving average line.
So one thing that we both learned from Bill was use precedent analysis as a guide, of what could happen, a potential roadmap. So this was a bad break. Now let's go out. Let's go out 2 days
Okay, and a
to
lot of times we
the.
start on the day to see
Yep.
what it looked like at that time. So you're kind of not not knowing what happens, and then you kind of let it unfold for you. And so as
That's a
we
very important concept for people when they're doing, because let's say you saw that and we had gone out a month and it had fallen off a cliff, you would go there and you would see all these negative signs of, oh yeah, it was obvious because. And if it's just a blip and a shakeout and goes higher, then your subconscious is going to want to see all the positive things. So that's why when we're doing it, even when the two of us have been doing it, we've done this for a couple decades now of looking through this, and it's a fun thing. I always look forward to that time with the two of us doing original research, and we always look at it on that day so we're as objective as possible. So at this point you would have been very concerned because you closed below your 50 day, your high was underneath your 21 day, um, and your high on this day was underneath your 50 day. So it's bad. And just so we don't waste time, let's go out to the recovery time. Let's just go out to the end of the year, end of December. And this could be something that could be in the cards that we deal with. Like if, let's say, Monday or next week, we take out today's low and we go lower, that we just need more time before you recover. So this is one that you might want to study over the weekend. And another one happened, let's look at September 3rd, 2020. This is something that probably everyone remembers.
and just for purposes of remembering, this is the COVID crash here. Then of course we had our follow through days on April 2nd and April 6th for the S&P 500 and Nasdaq respectively, and quite the run, quite the holding of the 21-day moving average line.
Yeah, so you could see how this was a total expectation breaker. Like just, we were up at highs around a round number on NASDAQ, and then you just fell down almost 5% in a day, closing at the lows. Didn't quite get underneath your 21 day. But this was a similar setup. And just because we're late on time, let's just go out to November of that year. Okay, that's your next day. You get support off your 50 day, but then you just go a little bit below it, and yeah, let's just skip forward. the chopping around. So this is more normal from what we saw. So we want to temper any enthusiasm or curb some enthusiasm of, even though I'm bullish right now, this is more likely to be in the cards where you need time before it recovers. And we'll end on this one. Let's go to Sammy Hagar's birthday in 1989.
Was that October 13th?
Yep. See, I'm teaching you well.
Look at me. and you know what? I didn't remember it because of Sammy Hagar. I remembered it because of the market. So.
Oh, okay. Well, no one's perfect. So this was a similar one, and this was kind of looked like SPY that it broke through your 21-day and your 50-day. But let's go out one more day.
And this was they called this a Black Friday. It was Friday the 13th. October 13th. There was some news out there. What was it? United Airlines.
Was it Fed related? I think.
I thought this was this the United Airlines part, or was
it the United? Yeah, the United. Yeah, you're right.
So, but yeah, going out a little bit further.
Some ugly intraday. That's why you want to take action on that first bad break day, because if you sat there, we were talking about at the beginning of the show of like other people that wait till the end of the week or wait until the end of the month or what have you, or give things more time. If you didn't take any action that first day to kind of like just psychologically to reduce your exposure level, you would be puking things out at the lows of that next day. Because how could you not? Because that could have been a serious crash. So yeah, let's go out, even 3 or 4 months after that. So we always want to look at both sides, because whenever you're bearish, you want to look at bullish sides. Whenever you're bullish, you want to look at potential bear setup. So that ended up looking like a lot of the ones that we were. But this was kind of the worst example where it went down for a long time before it came back. So just food for thought to balance out our discussion. Yeah. And we can go back to whatever you want to go to.
Another interesting one. Just I'm gonna add May 17th, 2017, only because this was Trump's first term. This was a very kind of low volatility overall period. But just playing this out real quickly, this kind of had a pretty quick recovery. So
this is what we're hoping for.
This is rare, not usually what happens, but it is a possibility. So, okay, let's talk about some stocks. And how about we start with, we'll finish the conversation up on Google, since you already discussed that a little bit. One of the issues here, and I do have a position in this, was that, as ugly as it looked on Wednesday, it still wasn't crashing below its pivot area. It was really just above the 10-day moving average line when you had a lot of the indexes, getting below the 50-day. So relative strength-wise, a lot of good power.
Yeah, so that's what you want to do this weekend is screen, use the Growth 250. If you're a member of the IBD Live, use the watch list that I put out there, the IBD Live watch list that you can find in Market Surge or in your email. And look for the ones where your RS line, which is that green line on there, is poking up for the week, or at least flat for the week. That's telling you, with all the destruction that we had this week, that it was able to buck the trend there. And that's what was happening with Google. We removed it from Swing Trader, I think on Wednesday, along with a lot of things, just because of what was going on in the overall market.
I think we were actually taking some off into strength here. You were expecting it to go to 200, right. And we were going to take it off on strength at 200, but it didn't quite get there on this day, so we took it off just a portion, and then the remainder on this day.
We took half off there and then took the other half. Good memory. And so I remember things from 30 years ago. I don't remember things from this week. It's weird. What can you do? So this has a really nice setup, upside reversal. Like I said earlier, holding above the 21-day, the lows, holding above it. So this is something where money is flowing into, and you've got the liquidity there. Unless there's some big negative news items that come out over the next week or the market falls apart, this one looks like it wants to revisit 200 and higher. So if you're looking for something to buy, this is, I think more from a swing trade at this point. Looks good.
Let's also take a look at in terms of heat, Broadcom is definitely had a lot of strength, and even though it came in, I mean, this was nowhere near the 10-day moving average line, but not nearly as great a close here.
Yeah. So, yeah, the close was weak. I have a position in this. This is one of my core positions. This in Tesla. And this week, I would, when all that devastation happened, what I like to do, and this is something I learned from observing with Bill and some conversations with him, is trying to hold my best stocks for the end. So when you go through market corrections, that can be 2, 3 days, 2, 3 weeks, 2, 3 months, you want to try to preserve your very favorite stocks, your best stocks, until the end. And sometimes you have to throw those out too if things get bad enough. So I'd whittled it down to, those two, and this was one of them. Don't like the close, but let's go look at it on a weekly. Given the breakout that it had from this base, and we've got a downside reversal on a weekly. The weekly chart looks bad, but in the context of how much it's moved up, 19% in 2 weeks, from that breakout level, I still think that's solid. On a weekly, it looks like it wants to move lower before it moves higher. Let's take a look at the daily again. And a lot of that was about the week close. Earlier in the day, it was looking much better. Still not seeing the daily.
It's there, I
Huh.
promise you.
I know. But anyways, we wanted to take out, today's high and close back above that in a short period of time. But more importantly, we just don't want to close below the gap up low. That would put it in a weak position. Shaking out below that, if I was a bear, I would push it to there to see if I could break the stock in two. But if it tests that and closes back up, that would be, an entry point, frankly, if you get an upside reversal there.
Okay. And we can also take a look at one we've been talking about it for a while here is GE Vernova. Such a strong gain here. Really didn't give up much, really kind of flattened out. I'm going to go to the weekly. It just really got support right there at the 10-week moving average line, kind of exactly the way you would want to see that happen. And, not too far off its highs.
Yeah, and I bought this back after we put it on Swing
I do have a
Trader.
position in this as well.
Okay, and this is one that Ali was talking about earlier this week on IBD Live, and let's go to the weekly because I think the weekly looks even better than the daily, and it looks like a classic model book type of move where you had your IPO, you moved up a little bit, you go sideways, you have a big advance, and then you come in and you test your 10-week line for the first time, and this was a successful test of the 10-week line. I'm assuming that the weekly is up there. I'm just envisioning it, and I'm wishing that it was there. I'm wishing I could see it. There it is. And so this looks very classic, and that's what you want to do. You want to look at a lot of model book type stocks. Those are just stocks that have gone up 100% or more during bullish phases in the market. The more, the better, and get to know what they look like on a normal basis. And this looks very normal. And Bill would always say, your first test of your 10-week line, which is that red line on there, equates essentially to a 50-day. That's where you would, if you missed it the first time, that's where you can buy it. Or if you own it, that's where you would want to add, kind of like a give me. So if it closes below, or even on a daily basis closes below this week's low, you'd probably exit that, if not before that.
Mm-hmm. Well, I think that wraps it up for us. Any kind of closing thoughts, Mike? Again, a wild week. Certainly could have shaken the best of us out there. But I think, for me at least, one of the lessons I learned from Bill O'Neill was, that flexibility of being able to shift. No matter how bullish you get, be ready to look at the other side for a bearish case, and no matter how bearish you get or afraid, be looking for those green shoots and the possibility of when things are starting to look better.
Yeah, I think that's such an important point that people don't get, especially with the kind of the media, with what you see on CNBC, or on Twitter, on X, that there's so much talk out there, and people kind of plant their flag in the ground. If they were bullish yesterday, they want to stay bullish because it's an ego thing. And it was so great that the two of us got to work with Bill so closely and get to see how flexible he was, and he did not care what he said. I know we're a little long, but can you tell briefly that story when you first started working with him,
Oh
and
yeah.
that the
So
letter that he put out?
yeah, so yeah, when I first started working for Bill, I worked for him for 15 years as his assistant, and I started in September of 1999. I had been at the firm for 2 years. In customer service is where I started, but 1999, I'm bringing him to the airport in my little Ford Festiva 3-cylinder, and bringing him to the airport in that little thing, and he was talking about how bearish he was. September of 1999, he had just sent out a letter to 500 clients about how bearish he was, how he thought that we needed a pretty significant correction to kind of get things back in line. And he went on his trip, came back. A couple weeks later, we had a follow through day, and he's
Want to pull
within a
up
few weeks.
the Nasdaq during that time frame
Oh
so
yeah,
they can see?
yeah, within a few weeks, he is back to back to 100% invested, and I was looking at his sheet. I could see his level of investment, and so again, very very bullish, very bearish here. And then I kind of started for him, and then as we kind of played this out, uh, by October, he was really you know really really starting to get bullish, and back in a very very big way on a lot of stocks. And look, if he had planted his flag in the sand, it would have been such a shame because he would have missed out on all of this, by just saying no. I sent a letter to 500 clients about how bearish I am. I have to stick to my guns or I'll look like a fool. He didn't care. He'd rather make money. And that's, again, it was a very important lesson.
Yeah, and we saw that over and over and over again, because I would talk to him religiously every throughout the week, but every Sunday night for like an hour and a half or so, give or take. And we talk about stocks and the market, and it took a little while to get used to that, because he was extreme. He was very bullish or very bearish. It wasn't wishy-washy. He pretty much had an opinion, and I think we're both like that.
and, and,
You know,
and a
he would
lot of
give
evidence behind it, right? Here are all the
Yes.
reasons why. And then again, a few days later, what about all those reasons? Yeah, it's different
Yeah,
now.
doesn't matter. Doesn't matter. Yeah, it's different now. And so people need to, I think, learn that lesson. I think you and I try to now that you're here, let's go out. I do want to go out to January of 2020
Oh, you really
there,
want to
because it
go record breaking, huh?
yeah, I'm
In
sorry,
terms of
but
how
this is
how long
important.
we go.
I know, but it's important.
We
We
started
we
late.
had all so this break there at the beginning of January, that was also very similar to what we just dealt with. So this could be another example that people should look at over the weekend. Go out to March just so they could see how uptrends handle themselves. And so you had that sharp pullback right back up to new highs. Just have another pullback that was even more severe down to the 50-day, then back up to new highs. So you've got to stay flexible. Bull markets do this. They try to shake that tree and try to get you out, but you don't want to, you don't want to be just rigid and stay there. You need to bend like a tree in the wind, as he taught us. With that, I will just say, if we don't talk to you guys, well, we'll talk to you guys on Christmas Eve with our
Yeah.
swing trader update. But for anyone else, just Merry Christmas, Happy Holidays. Enjoy your family or friends, and just try to help others around this time of year, because it's tough for a lot of people out there. So just be extra friendly to everyone you see.
Yeah. Well, thank you so much, Mike. Good advice for the holiday season. And again, we gave you some homework. Take a look yourself, change those dates, go through some of these time periods, and maybe we'll tweet out some more of those so you can kind of have some a little bit of homework over the weekend, but not too much.
I'll post that the spreadsheet that you put together
Yeah,
um,
very good.
for us. Yeah.
And just as a reminder, there's the three ATRs and the two ATRs. So we'll have to
I'll just
see.
do the three.
Okay, and the January 2000 was not a three. So that was one of the reasons why that didn't come up there. But hey, really appreciate you guys sticking with us since we started late. I hope everyone has a great holiday if we don't hear from you, and a great rest of the year. So appreciate you guys all taking a look at our stuff. If you missed Eve Bobach, it was a great conversation on IBD Live today. So you can check that out at investors.com/IBD Live. Mike and I will be doing the swing trader status update on Tuesday, a little bit early. And then I also have Arusha coming on the podcast. That's going to be Monday, a little bit early since we've got Christmas Day on Wednesday. So Arusha and I will be chatting on Monday to kind of wrap up the year on the podcast. So I hope you join us for all of that. We're trying to educate you all out there, and hope that it's working, and that you're having a great year in your stock market portfolios, and hope we can help be getting you up there even more. That's it for us this week. We'll see you next time. Bye bye now.